I'm delighted this afternoon that we're joined by Abraham Okusanya. Some of you may know Abraham. He's a regular guest blog writer for our website. Abraham is the founder of FinalytiQ, and we buy services from FinalytiQ, such as some of our platform and funds due diligence. FinalytiQ, Abraham and his team help us out with investment committee work, and were particularly instrumental in us launching our ESG portfolios last year. They also help us out with portfolio analysis and reporting. Another of Abraham's businesses that he runs, he's the Chief Executive Officer, founder of Timeline app, which is software that we use with you when we're doing our financial planning work and modelling, which helps us understand sustainable withdrawal rates from portfolios and how investment strategies will affect returns and lifetime income and outcome of financial plans. He's a successful author of many research papers and a very useful book for financial planners known as Beyond the 4% Rule, which drills down into lots and lots of detail on sustainable withdrawal strategies. We consider that we're very lucky to have him on the team at Expert, helping us and in turn helping deliver our work to you. Now, Abraham, are you there?
Yes, I am. Thank you, Dom. That's a very elaborate introduction. I should have you read it to my wife. She'll be very pleased.
Anytime, mate. Okay, so I'm just going to start with a couple of little gentle warm-up questions, and then we'll get into the meat of today, if that's okay. So notwithstanding what I've just sort of said in terms of a resume or a summary of your CV, can you just tell us a little bit about yourself in your own words for our clients that are here today?
Yeah, sure. So, well, look, what did they say? They say that, those people who can't teach. So, I think that's the saying. The way I like to think of myself and what, I haven't got the courage, if you like, to sit in front of clients and real people with, answer the questions and the challenges that they might be dealing with around their money. And so I hide behind those who can, such as yourselves. So yeah, essentially what we do here at FinalytiQ and Timeline, which is the software business, is that we provide research work around investment and retirement planning, and we sit behind financial planners who use this research and this technology to help answer their clients' big questions around investment and retirement planning.
Right, fantastic. How did you get into this business in the first place?
Oh well, how long have you got? It's a long story. I was born and raised in Nigeria to a parent of two teachers, and I grew up with the impression, my parents impressed upon me, that I had three career options. I could be a doctor, a lawyer, or a disgrace to the family. So invariably, I chose the third option. But I went to university, and finance happened to be one of the things that caught my interest. So when I graduated university, I joined the bank, which, so I joined Barclays right out of uni, and one thing led to the other. A couple of years ago, I think it was, 10 years ago now, I found myself in a position where I had to make a decision, and that ultimately led me down the path of setting up on my own, sets up the consultancy firm that is now called FinalytiQ. So yeah, I couldn't say to you that all the decisions been deliberate, but a lot of it has been, down to chances and opportunity presenting themselves to you, and trying to make the most of it.
And 10 years later, you've come up with some fantastic tools and resources that good financial planners around the world are using.
Yeah, I mean, we've been incredibly lucky. 10 years later, we have the software business that's being used by advisors, hundreds of advisors around the world, and a team of 25 people who are working hard every day to try and support the work that you do. So in that regard, we've been incredibly lucky.
Well, one of my old bosses used to say, "You make your own luck." I don't know how you feel about that, but right, thank you. That's really interesting. So, shall we move on? Is it okay to move on and start going down the rabbit hole of investments?
Absolutely, let's do it. Yes.
Okay. So, look, what I've got today is, I've no idea how far we're going to go down this particular rabbit hole, because I've got sort of half a dozen questions or so that have come in from clients that in one shape or form, and so we've tried to sort of order those into start off very gentle and then get more in depth, depending on how the conversation goes. So we're only constrained by we've got about an hour and a half in total, I guess. So if it's okay with you, we'll just sort of see how far it goes.
Absolutely, let's do it.
Okay, so where I thought we'd start, when we talk to clients about investing, we talk about owning the great businesses of the world as the growth engine of their portfolios, and blending those with what we call more defensive assets, loans to the great governments of the world. When we think about growth assets and defensive assets, in your eyes, what are they, and why do we mix them together in the way that we do? How does that help the portfolio constructions and the outcome for clients?
Yes, really good question, Dom. Thank you very much. So essentially, the way I think about growth assets and defensive assets is, think of them as your gin and tonic, right? Some people prefer gin and water, but ultimately think of your growth asset as the gin. It's the alcohol, and then you have the tonic, which is trying to mix things up a little bit, and you can mix that, i.e. the gin being the equity or the growth asset within the portfolio, and the tonic being your bond or your cash, and loans to the government, and mix that together for each individual, depending on their tastes, their preferences, and essentially that's the way I think of that's the way to think of portfolio and diversification. Now, in an ideal world, I say an ideal world, but in an ideal scenario, let's say that you are prepared to take, the strong taste of the gin. Well, then you just have the gin on its own. Now, don't ask me what that would do to your liver in the long run. I'm not an expert on that matter. So in an ideal scenario, you might just decide to just invest 100% of your wealth into equities. The problem with that is that the reward that comes with equity investing also come with the other side of the coin, which is the risk, and the risk being that with equity markets you go through periods of extreme declines, and most people cannot bear to tolerate this type of declines. I'm talking in some cases as high as much as 40, maybe even 50% decline in wealth. These declines tend to be temporary because the capital market or equities then do recover after a period of time. Nonetheless, most people don't have the if you like, the ability to hold their nerves through protracted period of time to see their portfolio decline, which is why we mix things up a little bit with the tonic, depending on each person's preferences for risk. They might decide to go one-to-one, i.e. half of the portfolio in equities and half of the rest, the other half in bonds. So the idea of bringing bonds to the picture. So bonds have, if you like, the opposite of what equities do. So in the long term, they don't perform exceptionally well. Don't give bounty returns in the long run. But equally, they tend not to decline, periodically or fluctuate, as much as equities do in the short term. So balancing the both, we can get to the sort of each individual's preference, just like you would do with your gin and your gin and tonic.
Yeah, I see. So where we're at is if I've heard you correctly here, what we're doing in the portfolios is we're blending equities, so ownership of the great businesses of the world, with, let's say, lower risk assets, loans to government, developed world governments, and in doing so, you're blending assets that behave differently at different times of the cycle. Have I got that right?
So you would expect that generally when equities zig, bonds will zag. So when equities decline, generally speaking, bonds tend to hold up their own or even deliver slightly better return. And so the overall journey will be smoother for the investor.
Right. So here we're talking about fairly big picture stuff, aren't we? Our balanced portfolio, as many of our clients will know, is a 60-40 blend of equities, shares with bonds.
Yeah.
So we have alternative portfolios either side of that, but what drives those big picture asset allocations in portfolio construction, do you think? And do you think that sort of world events from time to time should cause those to be reviewed, or not? Should those big picture decisions remain static?
Yeah. So the key driver of the blend between equities and bond within anyone's portfolio should come down to their goals and objectives. So it should come down ultimately to the individual. What is it that you are trying to achieve, and what level of return do you need to achieve that goal and the objective? And I suppose you can then bring in their preference to risk. So, are you the type of person who will be able to sleep well at night if the value of your portfolio gets suddenly, without warning, cut in half, over a short period of time? Can you stomach that kind of decline, even if we know both from empirical data and just, logical thinking. We can talk about that, but we know that, the great companies of the world, I'm talking about the Google, the Apple, the Microsoft, the AstraZeneca of the world, HSBC, these are the things that are in our portfolio. We know that it's not logical to think that the value of these companies are just declining out over a short period of time, and it's never going to go back up again. And now we can debate this matter and litigate this matter, but I don't believe that, given the weight of historical data over the last 300 years or so, that the capital market has existed, I don't believe that it's logical to come to that conclusion. But so even if we know that theoretically equity declines aren't going to be permanent, each individual still cannot, most individuals still cannot stomach that, that temporary decline. Yeah. And ultimately it comes down to, well, what should drive the allocation within the portfolio? It's the individual goals and their preferences for risk. As long as we get that right to start with, I don't believe that events of the world, such as the current one, should drive a change in your portfolio. As a matter of fact, it shouldn't. If you invest it right to start with, the investment should have accounted for market conditions such as this.
Yeah, I mean, I would just add to that we're very focused on. Obviously, we do risk profiling with clients, and we use that as a starting point for the discussion. But in our financial planning work that we do for clients, we're very keen to work out the best fit portfolio for the needs of their plan. And discuss with clients that what does risk actually mean? Is risk the portfolio risk of a temporary decline that will recover at some point, or is it the risk of running out of money? Before you run out of life, because that's not an ideal outcome, is it, by any means?
Absolutely. Ultimately, the goal, which in this case, in this example that you give, is, making sure that you don't run out of money before you run out of time, should be the absolute key driver. And I suppose what you're doing there is you're framing what risk actually is the risk. So yeah, absolutely. That discussion is what drives the asset allocation within the portfolio. Unless your goal and your objective has changed, I don't believe that there is a need to make any drastic change to your portfolio.
You mentioned the current crisis that the world is facing, the global pandemic. Clearly that's having a significant effect on the global economy right now. One of the questions that we've faced many times over the last few months is, how can I best paraphrase it? So what if this time is different to all the other times? What if the economic impact of the pandemic is that we have a depression like the 1930s? What happens then? Are all bets off?
It's a good question. And Dom, I remember being asked this question in the very, very early days of the lockdown. And my simple answer to that question, is it different this time? The simple answer is no. And why do we say that? Why do we say that this time isn't different than, as far as the capital market is concerned. Why do we make that assertion? Well, if you think of the capital markets, we call it stocks and shares, but I don't think we do it justice when we say that. When we say equities or stocks and shares, really what we're talking about is a tiny piece. You're owning a tiny piece of the great companies of the world, right? Now, as of the end of April, there are about 40,000 publicly listed companies around the world, right?
Yeah.
Now, if you look at one of the major indices that people look at to measure the performance of these companies, let's say the FTSE World Index, that would contain the 3,000 of the best and the brightest companies in the world, right?
Yeah.
And so when the capital market declined, and we make an assertion to say, well, this time is not different, just like other periods before it, the capital market will recover. What we're saying is that the capital market is an expression of the creativity of mankind, because behind these 3,000 best companies that were invested in are 3,000 CEOs and the executive team and millions of employees who go out every single day to create goods and services that other people need. Now, the pandemic has, put a little bit of a slowdown or a dent in their ability to do that. Now, let's not forget the fact that actually some of these best and brightest companies of the world are actually doing extremely well during the pandemic, such as Microsoft, whose channels we're using to have this conversation, or Apple or Amazon that has, just done incredibly well during this time. But the point I'm making is that collectively, there is a slowdown in economic activity. But that couldn't be. It's not logical to think that is a permanent damage and we're never going to come out of it, and this is going to be the end of capitalism as we know it, and frankly, the end of humankind as we know it. It's just not logical, just based on data. If you look at the capital market, it dates back 300-400 years. Every time the market has overcome some of the worst period known to mankind. To the extent that you believe in our collective ability as a race, our collective ability expressed through our governments, through science, and through capitalism, at the end of the day, the only bet we need to make is humankind going to survive this? Are we going to find a solution to this? And I am prepared to bet that, yes, we are. It's only a matter of time. To me, that is the only thing that I had to resolve in my mind to come to the conclusion that this time is not different, and these two shall pass.
Yeah, look, I don't disagree with you at all on that. What message I try and give out to my clients is, look, the cause of where we are today may be very different, but the outcome won't be any different. Us as humans, as individuals, we all want a better life in the future for us, for our children, for our grandchildren. We're all going to strive to earn money, and we all have a lifestyle that we aspire to and want to maintain. So inevitably, the economy is going to turn around. Nature hates a vacuum, and if there is a gap in the market for something, a service or a product, someone somewhere is going to fill it, and the economy will turn around. But just moving on a step, we've sort of, I expect we've done the what if this time is different question to death. You can't have an investment discussion for very long without mentioning Warren Buffett. And for anyone that reads the papers must have spotted recently that well publicized notes about the Berkshire Hathaway investment company. Warren Buffett sold out of all his holdings in US airlines. I think he owned Delta, Southwest United, and American Airlines, and he sold out at a substantial loss. Breaking his first rule of investment, which is don't lose money. And he was saying, the world has changed. So my question there is, certain sectors in the global economy could be perceived as higher risk now than they were before. Has the world changed to such an extent that as a result of the pandemic, that the portfolios now sit in a different place on a risk-return spectrum? I mean, we talked about airlines, but there will be other economies, other sectors, oil and gas, hospitality, and so forth, that make up some of the constituents that companies that we're investing in. Has the pandemic affected those companies more, and therefore where the portfolios sit on risk-return spectrum has moved?
So again, the simple answer in my mind, to that is no, right? So the answer to the question, as the world changed so much that the risk in the portfolio is now significantly different than what it was before the crisis. No, it hasn't, and I'll unpack that a little bit. But before I do that, let's just go back to Warren Buffett. You and I obviously adore a lot of his investment philosophy and ideas, which is essentially about finding great companies, investing in great companies of the world. He is known to have endorsed the idea of passive investing, not timing the market. As a matter of fact, a couple of years ago, he invited John Bogle, who is the founder of Vanguard, to his annual meeting and showered praise on the man. And so it's a little bit of a disappointment, if you like, that just after, in the latest, his latest update, just after he went on to say, don't bet against America, don't bet against capitalism. And then he went on to announce that he sold his shares in airlines and things like that. Well, should that change our view? Is that change the structure of our portfolios? Well, the answer, the simple answer is no. Why? Because, let me just give you an example. I mentioned, and forgive me that I keep going back to this, I mentioned the FTSE All World Index, which is the index of the 300 best and brightest companies, 3,000 best and brightest companies in the world, and things like that. And it's a really good measure of, well, to think about how global equities as a whole might perform. And so if you, ask the audience a question in your mind, have a number in your hand. So by far the biggest company in this index is Microsoft. So I'm going to give you that away for free. It's Microsoft. You tell me what proportion of the overall portfolio Microsoft account for. Just, type a figure into Teams or in your mind, and then I'm going to go ahead and tell you. Dom, do you want to guess?
I hope you're not putting me on the spot for that, because that's going to be a bit embarrassing. I'm going to say 1%, but I honestly don't know.
Right. Well, it's something like. And by the way, I am checking it up as well, right?
Okay. Well, I'm not on Google, so I'm not looking up. I'm not cheating.
Right. The computer knows it, right? It's somewhere. So I'm checking our system software that we use, for this data. So it's not like I carry it around. Microsoft is sitting at 3% of the overall portfolio. 3%, right? The entire airline industry, i.e. Southwest, American Air, and all that, I'm talking US now, if you put them together, right, they're not up to 3% of the global equity market. Do you see what Google is something like 0.9%, right? So the point I'm trying to make is, it's rather pointless to my mind to focus on one particular company or a small set of companies or even a sector. In the big scheme of things, these things are going to represent a minute proportion of our portfolio.
Yeah.
So what happens to them individually should be the least of our concern. What we're really betting on is the collective intelligence, the collective creativity of the best and brightest companies of the world. What airlines lose by the way of business, Apple or Amazon or Facebook, I don't know, or Alibaba in China, or Visa gains. So I don't really care about each individual one of them or a tiny little sector, or frankly what Warren Buffett does. What I care about, what I am betting on, is the collective intelligence of the bright and the best and the brightest, companies of the world, and their armies of employees who go to work every single day to try and do the best that they can for their families and for their shareholders. And frankly, what I am betting on is our collective intelligence as human beings, as workers, as scientists, as collective wealth.
Yeah. And I think it's worth mentioning. I mean, everyone likes to throw Warren Buffett out there as, Warren Buffett says this, therefore I must do that. There is a significant difference between Warren Buffett, aka Berkshire Hathaway, and Warren Buffett as an individual. And, to counter this point that he's making as Berkshire Hathaway, that he sold out of US Airlines, and he's therefore being very selective, making a very, very large, active bets on what companies are going to do well and what aren't. For his own personal wealth, he's very much in favour of an index fund, isn't he? Because he did also make the point that he hasn't changed his own will, which instructs his executors to invest 90% of his money in an S&P 500 index fund and the rest in cash, I think, isn't it?
Absolutely. So absolutely right. So, and by the way, Berkshire Hathaway represent 0.5%. Half of 1% of the great companies of the world, right?
About
this guy and his portfolio. But you're right. He did make the point that he hasn't changed his will, and the advice to his estate is, which is recorded in the will, is upon my death, 90% of of the wealth, of my widow's wealth, should be invested in the S&P 500, i.e. the top 500 companies in the US, and the rest, invested in short dated,
treasuries or whatever. Yeah. Sorry, go on, you go.
No, I'm saying, so the decision that he makes as a CEO of a company, a company that accounts for half of 1% of global capital markets, shouldn't really have any impact whatsoever on our own individual portfolio. If he's right, here's the thing. If he's right, well, we will benefit a tiny bit from it. Okay, maybe it becomes 0.6, percent of the company. If he's completely wrong, well, again, it barely registers.
Yeah. That's really true. Yeah. Okay, so moving the conversation on from like sector specific stuff in terms of like the airlines or oil and gas and so forth. One of the other questions that we've had from a client not long ago was they'd read in the papers about small cap investing and value investing and momentum investing. All different themes, and what the weekend press are like. They run what I call advertorials. They're articles, seemingly by impartial journalists, but essentially they're sponsored by some fund manager that's done pretty well recently. So things like small cap, value, momentum. What's that about? What does it mean? And is it something that private investors should be doing?
Yeah, it's a really good question. We're really geeking out here, but if you want to dig into this, let's do it. Just at high level, right? Value investing, which is actually, by the way, the type of investment that Warren Buffett practices, is essentially about buying companies, that are, broadly speaking, unloved by the market, and sitting on them and waiting for the market to recognize this one way or the other, right? So you're buying companies that are not necessarily popular. Now, these are formidable companies. One that comes to my mind, let's say Unilever, for instance. These are formidable companies. They worth billions and billions in many cases. But for whatever reason, they're just not in vogue right now because of, Facebook or Google or Apple or technology generally is all the rage right now. And so investors are disregarding or not perfectly accounting for the value of these companies yet. So, or it may well be that they are going through some sort of temporary problems. So again, think of BP during the leakage or the disaster that happened a couple of years ago. The market penalized BP for what they've done, and the share price dropped and things like that. So anyway, so value investing generally is about having a proportion of your portfolio. Again, going back to that gin and tonic analogy. So, value investing would be a brand of gin, or if you like, or a type of gin, maybe like that, within your overall portfolio. So the point I'm making is that value investing is about trying to gain exposure to this type of companies. So because a lot of research and data shows that in the long run, those type of companies tend to, outperform the general capital market. Not by a massive amount, but, enough for us to care about them.
Right. So it's a good thing. It's a good thing to try and capture that then.
Sorry, say that again.
It's a good thing to try and capture that extra return.
Yeah, obviously don't bet the market on, don't bet the farm on a horse. But yeah, it's a good thing generally to, have exposure to those type of companies within your portfolio. Obviously, even if you, even if you just hold the FTSE All World Index, you will still have some of those companies. So, but value investing is about placing a little bit more emphasis on those companies so that you will own a little bit more of them they will form a slightly higher portion of your portfolio than the overall market.
Right.
But what we don't often get told, and the data shows this, is that although these companies outperform in the long run, again, because they are risk factors, they're not free lunches.
Yeah.
They don't always, outperform year in, year out. So they go through periods that they get ignored or neglected or underappreciated by the capital market. Generally during bull market, during times that the market is prosperous and there's hype about technology, they get slightly ignored. But during difficult times, especially coming out of a recession, these boring companies that food manufacturers or utility, maybe even retailers, they tend to do better coming out of recession. So the risk is that they go through periods of prolonged period of underperformance, and the last 10 years has been one of those periods when these value companies haven't done very well. They've been neglected, and they continue to be neglected by the overall market, because again, everyone's focusing on Google and Microsoft and Apple and technology companies, AstraZeneca and all the other sort of boring, Coca-Cola, all the other sort of boring but incredibly successful companies haven't, people haven't paid a lot of attention to them, but they continue to manufacture good, successful goods.
Yeah.
To sell them and generate revenues, but they're not particularly loved or favored, or there aren't so much hype around them as you do around growth companies such as technology companies.
Right. Okay. So you mentioned specifically value investing and say that, basically what I've heard is there's no such thing as a free lunch. You should in the long term get extra return, but that doesn't necessarily mean that in the short term you will be. So it doesn't necessarily mean that in the short term you'll get extra return. So again, don't bet the farm on everything in value stocks, but have it as a small part of the portfolio. Is that right?
Absolutely correct. And again, I've read in the news, people who bet the farm on the horse, so known value investors such as, let's start with Warren Buffett. His stocks have underperformed the S&P 500 quite significantly over the last 10 years now. It hasn't, resulted in him being out of a job, but others haven't been so lucky. So you might have read of Neil Woodford.
Yeah.
Who partly, a part of the problem is hubris and arrogance, frankly.
Yeah.
But part of the problem is also the fact that, he is a value investor. They bet, exclusively on value, although he started doing other things that people didn't understand. But he's not been so lucky. His fund underperformed massively, and people lost quite a bit of money because, the fund ultimately ended up shutting down.
Yeah.
His best known protege, what's his name again?
Mark Barnett as well has left Invesco, hasn't he?
Yeah, again, another value investor. These are value investors.
Have we lost him? I think Marcus is having some internet issues at the moment, so just bear with us while we let that sort out. But whilst I'm assuming that you can all still hear me, I was just going to say to Abraham there before we lost him that in relation to Neil Woodford and Mark Barnett, it's the old adage that the market can remain irrational for a lot longer than you can remain solvent, and that caught them both out quite dramatically in both cases. If you've seen in the papers recently, Mark Barnett has just left Invesco, or been forced out of Invesco Perpetual down in Henley. So Marcus, have we got you? You're back. Is Abe with us still?
Yes, I am.
Oh, good man. Right. I don't know whether you heard me at all there, Abe, but I was just saying the old adage that the market can remain irrational a lot longer than you can remain solvent, and that definitely caught out Neil Woodford.
Yes. So people who did focus their investment approach on value plus other things, cost and media and all that stuff. But those people are they've not fared particularly well in the last couple of years. Yeah.
So continuing this thought process, then, we're getting into some quite sort of detail here about different types of investing. We've mentioned small cap, small companies, value investing, momentum investing. A lot of this is about those particular factors might perform at different times of a market cycle, which sort of leads me on to the thought process about market timing. Wouldn't it be great if we could get the timing right for when to invest in those things? And that's really tricky, isn't it? But I saw again, sorry, you have to sort of bear with me on my thought thread here. I think it was not last week, but the week before, it was reported in the papers that the most popular funds, in March or whenever it was, were things like UK gilt funds or cash funds and other low risk type funds. Real people, whether they're advised or not, are investing their money out of growth assets. Remember from where we started in the conversation, been owning the great businesses of the world, into more defensive assets. Do you see any particular issues with that in terms of selling out of growth assets in a downturn, which by historic standards will be temporary?
Yeah, that's a great question. So I'm going to read you a statement, Dom, and so to me, this is about diversification, right? Mm-hmm. We diversify across different style of equity investments because we accept that we don't know precisely when and if each of these factors is going to perform. We don't know which one's going to do best at which time, right? So value investing has tend to do well at different periods, but we don't know exactly, right?
Yeah.
Momentum, which is momentum. When people say momentum investment, just think of something that has tail in its wind. So the capital market, for instance, over the last 10 years, for the most part, the overall market is had a bit of tail on its wind, and it's been going up and up and up and up and up. That is momentum happening, right? It's an inbuilt property of the market. And then you have small cap investing, which is essentially about investing in companies that are still small, could end up becoming very successful. So, think of, we talk about Apple being a $1 trillion business today, but at some point there was we wouldn't be having this conversation because you'll be so wealthy, out of your mind, you'll be sailing the world over or something. But anyway, but the point I'm making is that is a style of investing, i.e. trying to buy small companies, some of which might end up being really successful. But the key is we don't know when any particular type of investment will outperform. There is indeed no guarantee that they will. And so we diversify. And so the quote I wanted to bring out is this: diversification is humility made flesh. The embodiment of managing ego risk, a concrete nod to the uncertainty inherent in money management, and an admission that the future is unknowable. And that quote is by Dr. Daniel Crosby, who is call him an investment psychologist, right?
Yeah.
We accept. We don't know. I don't know when value companies are going to outperform momentum or the overall market. I don't know when small or if smaller companies are going to, ultimately outperform the overall market. The data tells me broadly, but it's not precise, right? And so humility for me, and for us, is by, accepting that we don't know these things, and so we diversify. We have exposure to these things within our overall portfolio, and that has shown over time to be a very reasonable, a very robust approach to investing. Like this, what was the quote? Sorry, the quote is something like, "I diversify. I wouldn't make you a killing in the stock market necessarily, but I won't get you killed either." Yeah.
You don't. I think the quote is, "You don't own enough of anything to make a killing, but equally you don't own enough of anything to get you killed." Something like that, isn't it?
Yeah, and again, if you remember, in March, we were reading in the press that some advisors and indeed some investors were selling out of equities because when the FTSE all world declined, I think it was 30%, or something like that, and people were selling out. They were selling out at the bottom.
Yeah.
And subsequently, what's happened?
Well, it's rebounded, and we've had some of the best days in the market since ever. Since then, we've had some of the best days in the market ever, haven't we?
Absolutely. And so, this idea that people will be, going in and out of the capital market is such a dangerous idea. It's not just bad. It's dangerous for your wealth. You're buying low. You're buying high and selling low.
Selling low. It is pure wealth destruction, isn't it?
Yeah, absolutely.
So if we're not going to market time, which we don't do, we say to clients always, look, no timing, no selection, It's about time in the market, and we operate a buy and hold strategy, and we're clever enough to know that we're clever enough to know what we don't know. If we're not going to do that, given that many of our clients are in the spending stage of life, is there anything that they could or should be doing now to help stretch their money further, to make their money last longer? Should they be stopping portfolio withdrawals, for example, and pulling money from contingency funds of cash? What are the typical strategies that people should be thinking about now?
Look, we've said this before, and I remember when you had this really good client event that I was privileged to speak at. Look, ultimately it goes back to this. I'm sure you've done all this, so I'm just basically, repeating this stuff. But ultimately, I am sure that you've worked with each client to decide their goals and objectives. You've constructed the asset allocation and the portfolio based on that. I'm sure that you stress tested the client's, portfolio and their withdrawal sensitive data that we provide in timeline, and that data is essentially about thinking about worst case scenarios and having a plan for those worst case scenarios. All of those things you've already done, and I think I've heard you say this, Dom, a few times, that the best time for a boat drill is before the storm comes, right? During the storm is the worst possible time for your drills, right? So all of that's been done. I don't believe that there is, unless you build a plan that says, well, look, in a difficult market condition such as the one that we're in, we may have to reduce your withdrawals from the portfolio. That could make a difference. But unless it's in the plan, if you build a plan that accounts for a market downturn such as what we're seeing, all you have to do is follow the plan. Now, we're tracking the current market condition, comparing and contrasting with all the previous ones. So the previous ones. So far, what we've seen is that the current market decline is well within historical range. It's not even close. I mean, so far the global equity market year to date is actually maybe, about -6% over the last 1 year. Maybe about -2%. This so far, based on what we've seen, we don't know what tomorrow holds or what's going to happen next. Not the day after, but so far, the current market condition is totally within the range of historical scenarios over the last 100 years. It's not even close to the Great Depression. Really, I hear this in the press all the time, and they say, it's the greatest financial crisis since the Great Depression, or worse than the Great Depression. We don't know that. In the general economy, we really don't know as yet. But as far as the stock market is concerned, and by the way, the stock market is always forward-looking than the overall economy, right? So far, the market is well within historical bounds. You shouldn't have to do anything that you don't already have in the plan. I don't see the need, frankly, unless it makes you happy or sleep well at night, to have to be selling down your portfolio to cash. That's what bonds are there for anyway. If you have a 60-40 portfolio, a balanced portfolio, well, 40% of the portfolio is in bonds, is in global bonds. And again, here today, global bond is probably done 5% positive in return. And so you see where I'm going with this. I don't see they need to do things that are not in the plan. Now, if you don't have a plan, and I'm hoping, I'm praying that there's no one on this call without a plan, then of course it's a different conversation to be had.
Yeah, it's always worth mentioning, I think, that the economy is not the stock market and the stock market is not the economy.
Absolutely, yes.
Yeah. I was just while you were talking now, I was just looking at the portfolios on the Betafolio site. Over 1 year, the P60 balanced is down less than 1%.
Yeah.
To latest data, which is 27th of May. Yeah. So we're down less than 1%.
Yeah, and that is the benefit of diversification, because if you drill into I know we're risk going down the rabbit hole a little bit here, but if you drill into the portfolio, you will see that global bond, over the last 1 year is done about 6%, broadly speaking, 6%, and then global equity over the last 1 year is actually in a positive territory. So if you balance this out, right, what is in the equity, you gain in bonds, or vice versa, or it may well be that the value proportion of a side of the portfolio is done a bit worse. Over the last 1 year, the value element of the portfolio is probably done minus 10%, but it balances out so that at the end of the day, we're kind of sitting in a position, as you said, over the last 1 year, portfolio 60-40 is what, minus 1%.
It's less than 1% over 12 months.
Oh, sorry, less than 1% over 12 months. So, which is not even, worth losing anyone's sleep about. This is so far. I'm sorry to say, so far, this is within the normal range of scenario for the market. I know. I know we have a bigger problem to deal with, health-wise, and certainly in the general economy in terms of the possible unemployment and things like that. But the capital market is looking forward and is making an assumption that we're going to deal with this problem. That's what investment is doing. That's what the capital market does.
Right. Okay, thanks for that, mate. So I've got a question come through from one of our guests today. So I'm just going to put you on the spot with this. I hope you don't mind, because you've had no warning. Question is, given the global pandemic, when is the right time to invest? I postponed my research because I'm a non-investor at the moment.
It's a really good question. Time to invest, it'll be yesterday, What's that saying? The right time to
plant a tree was 20 years ago, and the second best time is today.
Because the next best time is now, right?
Yeah.
If you're sitting on a lot of money, if you're sitting on a lot of money and you do need to invest, let's make that assumption, because some people don't. You might have enough wealth that maybe you don't need the risk. Maybe your beneficiaries don't need the risk either. But if we make that assumption that you want to, you need to invest and you want to, well, then now is the time to do it. You should have done it yesterday, maybe last month when equities declined by 30%. When we were saying, I think the talk among advisories, there is a sale in the capital market. The trouble is that everyone was running out of the shops. That would have been a great time to have gone in. But again, you couldn't have timed that. No one could. We don't pretend that we could. So yeah, next time is now. If it makes you feel comfortable, although I don't theoretically, when you look at numbers, it doesn't make sense to repeat money into the capital market gradually. There's tons and tons of research on this. You can probably do that research on Timeline, our software as well. it just doesn't make huge amounts of difference to drip feed the money. But if it makes you sleep better at night, then maybe that's a compromise to say, well, I'm going to drip feed the money into the market over the next few months. Also.
Yeah, I mean, you know, I absolutely agree with you. I mean, I've been doing this job in one way or another for 35 odd years now, and I've never known. You know, I don't know how many market crashes I've lived through in that time. I mean, on average, once every 5 years. So what's that? Seven or eight market crashes, I guess. You know, some pretty big ones. You know, I remember the financial crisis of 08, 09 and the markets tanking. I think I was sat in a hotel room in a very rainy Mallorca at the time when the markets were tanking, looking at my computer screen going, oh my God. But I've never known an investor to come out the other side, you know, in a better place because of they phased in an investment. You know, that ultimately the fact that they have phased in has been forgotten, you know, 10, 15 years down the road. And it makes bugger all difference, excuse my French, it makes no difference to the outcome at the end of the day.
Yeah.
So I've got another question. We've got a few minutes left. Are you still okay for time, Abe?
Yeah, I'm good.
Yeah, okay. So we've got another question here from someone. So this is about sustainable withdrawal strategies, and the question is, beyond 4%, what sustainable withdrawal rate are you currently recommending? And I think that's a really challenging question because it moves beyond the financial plan and the needs of the financial plan. Maybe we just need to interpret the question a little bit in terms of what are we actually getting at here? Yes,
absolutely. I mean, it's a question that comes up again. It's a financial plan. It comes down to each individual's preferences and needs. So the asset allocation will have an impact on the withdrawal rate. Typically speaking, the higher the equity content in your overall portfolio, the higher the withdrawal rate is. But time horizon also has an impact. So the withdrawal rate that I would that you would recommend for a 60-year-old is different than a withdrawal rate for a 65-year-old, even with the same portfolio, right? I haven't got all that out of the, and again, another point that we haven't talked about or that we mentioned earlier on, the amount of flexibility that the individual can cope with, i.e. adjustments in their withdrawals in bad market condition also has an impact. And so, for instance, you might say, well, if I say 65-year-old in a 60-40 portfolio, ignoring just taking account of the portfolio cost and reasonable advice fees, will probably be fine on a withdrawal rate of about 3.5 adjusted for inflation. If they're saying, I am not willing to reduce my withdrawal in bad market condition. Whereas an individual in the same shoes who is prepared to maybe cut back a little bit in bad time may well be fine, comfortable, fine with an initial withdrawal rate of 4.5% in the knowledge that actually maybe even 5% in the knowledge that actually if they do encounter a poor market condition, they can maybe reduce the withdrawal back and pull back a little bit. So it's a very personal question, which needs careful planning with needs a meeting with Dom on that one.
Yeah. So what I'm hearing there is that the two things that are most critical are, or maybe three things. is the time horizon. How long have you got? Yeah. Your asset allocation to equities and bonds. Yeah. And what you do, when the market temporarily tanks, do you stick with that withdrawal rate, or do you or do you reduce it?
Absolutely.
Right. So okay. So let's just take that one step further then. So you've got your portfolio strategy. Let's say you're in a balanced portfolio, P60, 60% equities, 40% bonds. You're taking a withdrawal from the portfolio. The market tanks. Let's say your portfolio drops 10%. What makes the most difference at that point in terms of your lifetime returns? Reducing or stopping your portfolios, or tweaking the asset allocation? Say, well, the market's tanked, I'm going to go up to 80% equities.
Without a doubt, changing your withdrawal.
Right.
That's
really interesting.
No doubt. There are tons and tons of research on this. The withdrawal, and by the way, thankfully, it's actually one of the few things that you can control, makes the most difference. Changing the withdrawal makes the most difference, more impactful than changing the asset allocation. And not just more impactful, the impact are a lot more, I don't want to use the word predictable. The impact are a lot more predictable. So in other words, changing your asset allocation, well, it could be for the better or for the worse, we probably wouldn't know, although directionally we know that having more equity tends to help.
Yes, but you could get, sorry to interrupt you, you could get the timing hopelessly wrong on that, couldn't you?
Absolutely.
Yeah, because you might in mid-March 2020, you might say, oh, the market's dropped 20%, I'm gonna sell all my bonds and buy equities, and then the market could drop another 20%.
Correct. Right.
And then you're really screwed.
I like that technical term.
Sorry.
Yeah.
Sorry,
but
it's your influence on me. Sorry.
You couldn't get it wrong with withdrawals. I.e., we know that if you then say, well, I'm going to reduce my withdrawal by 20% or whatever during that period. We know the impact of that is predictable. We know that it will make your portfolio last longer, whatever the market does. So, yeah, absolutely. But again, just to go back to this, that I wouldn't consider a 10% drop in a 60-40 portfolio necessarily one that should prompt an adjustment to the withdrawal. I would be, that probably is still within range of what you would expect in a normal market condition. Maybe if we get to 15% and partly 20% drop in a 60-40 portfolio, then yes, we should absolutely do something.
Yeah.
That's
yeah. So look, we need to start wrapping up. Because we're coming to the end of our time here, and it's been fantastic to talk to you, Abraham. I always enjoy talking with you, and just before we sort of start the wrap up, if it's okay with you, I'd really like to get you back again in maybe a few months' time, and we'll do a similar sort of thing. Would that be okay? And because I think the insight and wisdom that you bring to us and our clients is fabulous.
Well, every time I get the chance to speak to real people, I do a lot of talk to financial advisors, but every time I get to speak to real people, I absolutely relish it. I don't know though. I worry that we might have bored the audience with this.
I can't see how many we've got here, but we were due to have about 35 people logging in today. So yeah.
Well.
Anyway, let's just summarise. The key message I'm getting from today, the key messages are that if we take the lesson or the bit we spoke about Warren Buffett in terms of aviation and stuff like that, is you don't need to search for the needle in the haystack. You don't need to have the next Google or the next Facebook or anything else. Just buy just buy the haystack. Forget about searching for the needle in the haystack. Just buy the haystack, and then you've got it. And timing and selection of what to be in, whether to be in value or small cap or large cap or momentum, just have everything in the portfolio so that you're thoroughly diversified, because diversification is your friend. And don't try and time the markets. And then finally, the one final point I'd make that I think you're making, Abraham, is in terms of tactics to employ when things are seemingly not going right, is don't change the portfolio, but change your behaviour in terms of portfolio withdrawals. Is that a fair summary?
Absolutely, yes.
Okay. Well, that has been really fascinating, Abraham. I'm so grateful to you for your time, your insight and your wisdom today. So thank you. I really hope we can get you back again in a few months' time for another event like this. It's been from my point of view thoroughly enjoyable. I do hope our clients that are with us today have enjoyed it. And thank you as well to the clients that are here today, and thank you to them for their continued support. So I think we should probably wrap up there if there's nothing else at all.
No, thank you for your time, Dom, and thank you for John and Marcos as well for the good work that you're doing. Thanks for having me. Really appreciate it.
All right, great. I've just got one final announcement, folks. If you're still with us, we have 2 more events coming up on the 10th of June with Neil Bage from BIQ. We're going to rerun that event from a couple of weeks ago. And then we have on the 23rd of June, we have Louis Volbrecht from Kinder Institute is going to talk to us and to you all about life planning. So that's our next few events coming up. And we'll get details of those out to you in due course. So thanks once again for your time and your attention today and for being with us. It's been really great. Thank you very much, and we'll see you next time.